Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to the Better System Trader podcast. Glad you could join us today for this episode number 158. Now, with recent market actions or stock market actions, talk again is turning to whether this is just another correction. Will the bull market resume, or are we in the beginning stages of a bear market? In this episode, we take a timely look at the market with Troy Bombardia from investment research firm Fundamental Capital and also from the website bullmarkets.co. Troy has been working in his family's hedge fund for 10 years now, and he applies a unique mix of fundamentals, technicals, and statistics to his trading models. In my discussion with Troy today, you're going to discover a number of interesting topics, including why technicals alone can't give an accurate reflection of the long-term market view and what you also need to incorporate instead. We also talk about why lots of traders that use fundamental analysis are doing it wrong and which fundamentals really drive stock market declines. Troy explains the difference between a bear market and a big decline and the conditions to watch out for in each of those. We also talk about leading economic indicators and why they're also leading stock market indicators and how to read them to prepare for potential market changes. And then we look at those economic indicators and see what they're saying about the stock market conditions right now, including when the bull market could potentially be ending and the final step to watch out for as it unfolds. And then we wrap things up with a bit of a chat about the importance of reflection in trading and the two key aspects that traders need to focus on to always be improving. So we do cover a lot of interesting points in this episode. Let's jump over now to my chat with Troy Bombardia. Hi Troy, welcome to the show. It's really great to have you here today.
Hi Andrew, thank you for having me on.
Yeah, it's cool. We've got some really interesting things to discuss today, especially due to the action we've seen in the stock market recently. So I'm pretty excited to be asking you about that and your insights that you have for us there. But before we get into all of that, how about we start with getting to know you a little bit more. So can you perhaps give us some of your background, what interested you in the markets, how you got started?
Right. So I started in the markets around 10 years ago. So my parents run a small hedge fund, and that hedge fund's mostly just for family and friends' money. And I started working with them around 2008, just when the financial crisis and the stock market crash of that year was starting. And so we made a lot of money that year in 2008, almost doubled our capital, shorting the market. And our thesis was basically, you got to short the worst sector, which is finance, right? So that sector went down, we made a lot of money, and straight from the beginning, we were doing leverage ETFs. So hence that compounded the gains. And then 2009 is pretty obvious the market was going to rally because in a bear market, there was always going to be a rally, right? No bear market goes down in a straight line. So we bought before it bounced and we made money from that. But after that, because we subscribed to conventional trading wisdom, which is that, the economy is bad, hence, it must still be a bear market, combined with the whole secular bear market idea from 2000 all the way to 2009, saying that, hence, it must be a bear market. This market's going down. It must be just like the 1970s. And needless to say, that did not work in the second half of 2009 all the way to present. So 2009 wasn't such a great year, the second half at least. And 2010, it wasn't that great either. But by that point, we had moved away from trading the S&P. So we used to trade the S&P mostly with leverage ETFs, for example, UPRO, and SSO, which is the S&P's 3x and 2x leverage ETFs. And at that point, basically, we're like, okay, what we're doing isn't exactly working too well. Let's switch and focus on trading silver. And basically from around 2010 all the way to around 2015, 2016, all we traded was gold and silver. And we did really well with that, 40x our capital during that time. And once again, using leveraged ETFs for silver, for example, AGQ and USLV, which are the 2x and 3x leveraged ETFs. So that's the focus of our fund.
Right. So from there, how did you progress to the approach that you're using today?
Throughout the entire process, I was just wondering, why is it that our stock market outlook for the US stock market was honestly no better than a monkey throwing darts at a chart, as Warren Buffett would say it, right?
Yeah.
and it struck me for a long time. And it wasn't just us. If you look at the whole professional trading community and the hedge fund community as a whole, on average, the average hedge fund can barely beat buy and hold, right? And if you really think about it, there is really no other industry where the average professional firm can't even beat mom and pop doing nothing but just buying and sleeping, right? So it made me really wonder, what is it that isn't working? And then it just kind of hit me. It's because when you're trading gold and silver, you're going to be using technical analysis, whether you use that through a quantitative model or if you trade that using a discretionary approach, right? For example, you're staring at charts, whether you use chart patterns, breakout breakdowns, contrarian trading, that's all technical analysis, right? And then it made me think, maybe you got to be looking at fundamental analysis for the stock market. Maybe the stock market is different from, for example, currencies and commodities in that the fundamentals have a big impact on the US stock market, right? So going along that train of thought, and the thing is, whenever you're not doing something too well, you always want to think, who can I learn from? Who is the best at doing what I want to do, right? And one of the best hedge fund managers, there's two of them. One is Jeremy Grantham, and the other is Ray Dalio, right? And both of these hedge funds employ fundamental analysis in their trading, regardless of their time frame. For example, Jeremy Grantham has a very long time frame, whereas Ray Dalio has a shorter term time frame of around 1 year to 1.5 years, right? So going along that train of thought, okay, so maybe fundamental analysis actually does work. But then the thing is, a lot of what traders believe and what we used to believe as fundamental analysis for the stock market isn't actually the right way of doing it. For example, a lot of traders will think, earnings growth is slowing down or earnings growth is accelerating. Hence, if earnings growth is slowing down, it must be bearish for the stock market, right? And what I found is that factually, when you actually look at the data, that is not true. The economy and the stock market, their correlation is that they move in the same direction in the long term, but they don't move at a 1-to-1 pace. It's not like the economy improves at 1%, hence the stock market improves by 1% at the same time, right? When the economy is improving, the stock market is going to go up at a faster pace, percentage-wise, right? And when the economy is getting worse, the stock market is also going to go down at a faster pace, percentage-wise, right? The stock market, being that it reflects human psychology, trader psychology, always amplifies what's going on in the stock market in the long term, right? So basically, going along that train of thought, I read a lot of Jeremy Grantham's letters from 1997 to the present, and basically I reverse engineered a lot of his ideas. So I'll give you a couple of simple examples. The first and most important example is that fundamentals are actually more important than valuations. So a lot of traders think that valuations are the most important fact to understanding the economy's fundamentals. And that is actually not true. Valuations are a secondary factor. The first and foremost factor is that you have to know if the economy is going up or if it's going down. Is it an economic expansion or is it a recession? And it doesn't matter if the pace of the expansion is slowing down, as long as it is still an expansion. That's what's important, right? Because when you look at history, when you look at the US stock market's history, right, for example, the S&P 500, all of the major declines have occurred within the context of a recession, right? All of the 40% plus declines have occurred within the context of a recession. And the other thing I would like to note is that I split the declines into two groups. So conventionally, people would define a 20% plus decline as a bear market, right? And I don't do that because what you notice is that there's a fundamental difference between, for example, a 40, 50, 60% decline and a 15 or 20% decline, right? Because using, just a conventional negative 20% cutoff line to define a bear market makes no sense, because that's not what a bear market is. The basic definition of a bear market is you have to have repetitive selling that causes pessimism, and that pessimism feeds on itself, right? So if the market goes down 20% today and it snaps right back up tomorrow, it is not going to cause that nonstop pessimism that feeds on itself, right?
Yeah.
So hence why there's that massive magnitude component to it, the 40% plus bear market, but there's also a time component to it. Because, for example, in 1987, the market drops 22% in one day, right? There's no, long bear market like 2008 that follows. The market goes right back up, right? Hence why it's also important to have a time component defining those 40% plus bear markets as a 1 year or greater decline, right? So when you look at history, all the 40% plus declines, which are rather rare, that last more than 1 year, they all happen within the context of a recession, right? But on the other hand, not all recessions result in a 40% plus decline. Sometimes they only result in a 20% what we call a big correction, right? So how do you know if the next recession is going to cause a bear market or a 20% decline, right? Is it 20% or is it 40%? Because there's a massive difference between the two, right? And the answer to that is that's where valuations come into play. When you get a recession combined with high valuations, which is kind of like having two problems in one, then you get a massive 40% plus bear market, right? But when you get a recession plus low valuations, you only get one of those like 20% plus big corrections. And if you want to think about it this way, think of the analogy as somebody jumping out of a building, right? If you jump out of the 10th story window, you're probably going to die, right? But if you jump out of the first story window, then you're probably just going to break a leg. You're going to get hurt, but nothing terrible is going to happen to you, right? So valuations are kind of like what floor of the building you're on. So basically using that idea, because we thought about that idea also because what we found out is that using conventional technical analysis, like technical indicators, there is not a single indicator that is going to tell you this is going to be a 20% decline or that this is going to be a 40% decline, because technical analysis reacts to the price. It can't exactly predict the price that far into the future, right? For example, technical analysis might tell you, next month, here's the most likely direction. Next 3 months, here's the most likely direction. Next 6 months, the most likely direction, right? But it's not going to tell you 3 years down the line, here's where the stock market is going to be.
Yeah. So you've mentioned there that you're looking at things like the fundamentals to try and determine if the economy is expanding or contracting. But can you kind of explain at a high level how you actually apply that knowledge or those fundamentals to your trading models?
Okay, exactly. So, for example, as you'll probably know, if you were to use, for example, a simple indicator like RSI, right? Sometimes the market will bottom when RSI, I'm just throwing an example here, it hits, for example, 30, right? But sometimes the stock market will only bottom when RSI hits, for example, 15 or 10. And for RSI to go from 30 to like 15 or 10, that's a massive decline, right? So what that's saying is that you cannot be using the same technical indicator under different market environments, right? For example, an RSI of 30 might be oversold in the bottom in a bull market, or an RSI of 15 might only be the bottom in a bear market, right? So if you were to use a one-size-fits-all technical indicator, say a rule saying buy when RSI hits 30, that's going to work in a bull market, and you're going to get slaughtered in a bear market, right? Whereas if you were to set the requirement very strict, say only buy when RSI hits 15, that's going to save you in a bear market, but you're going to miss out on the bottom in a bull market. So that's the problem that we had before, is that if we realized that if you just use technical indicators, it doesn't work for the other market stage. If it works for a bull market, it's not going to work that well for a bear market. If it works well for a bear market, it's not going to work that well for a bull market. Hence, you have to have something that tells you what the long-term direction is, because you cannot be using the same set of indicators in a bull market and in a bear market. So that's why we use the economy to understand where the long-term direction is. If the economy is improving, hence it's a bull market. And if the economy is getting worse, hence it's a bear market.
Right, okay. So that's how you're integrating the fundamentals into the long-term view and then the technicals into the medium and short-term view. So that's how you're marrying the two together.
Exactly.
Okay, cool. So, but some of these fundamentals are quite long-term, as you've mentioned, and if you look back through history, they can move quite slowly, or you can have very low sample size because of the long-term view. How do you actually address that? Have you verified any of these fundamentals with quant studies?
So the thing about that is, yes, we have done with quant studies, except as you have already mentioned, is that you have very little sample sizes, right? So the way to deal with that is that you can't always think of it in terms of statistics and a quant. You have to think about the logic behind it, right? Because, so basically when you do that, you just got to ask yourself, is it logical that the economy and the stock market move in the same direction in the long term, right? And I believe that it is, because think about it this way, right? The reason why the stock market has a long-term bullish bias, it tends to go up more than it tends to go down on any given time frame, is simply because the stock market is a reflection of corporate America, right? In terms of that reflects the profits that corporate America makes, right? Let's say, today corporate America makes $10, and in 50 years, corporate America makes $100, right? Well, if you're the owner of an asset, the owner of a stock, you're probably going to pay more for something that makes $100 versus something that makes $10, right? So that's what that is the economy. For example, if you were to look at something like the S&P 500's forward earnings and plot that onto the chart of the S&P, you see that these two move in the same direction in the long term, right? Because the stock market is stocks at its core, and stocks are companies that make money, right? So if you were to think about it that way, any stock on its own can be impacted by its own company's problems or successes, right? Like Facebook has their own problems, Google has their own successes, and all that stuff, right? But when you average all these things out, when we're just talking about the broad stock market itself, it's going to move in the same direction of the economy. For example, let's say the economy is going good, right? Hence, consumer spending is getting better. Yes, during that period, some companies might, have crappy products. They might do worse, but other companies are going to be creating good products. They're going to do better. And on the average, when you balance these two things out, their corporate profits are going to grow with the economy in the same direction. You're not generally going to have a case where the economy is doing great and corporate profits are declining, right? So basically just saying that there are quant studies for this, but like you said, the sample sizes are really small. And if you were to just use a pure statistical approach to that, you're not going to get enough sample sizes. Otherwise, you need, for example, 200 or 300 years of history.
Yeah, and that can be tough to get your hands on, right?
Yeah, exactly. Back then, they didn't even do the stuff. So
Yeah. Okay, so you've kind of explained then how you look at the longer term using fundamentals. What about now if we shift to the medium and shorter term, which sounds like that's where you bring the technicals into it. So how do you apply the technical side of things for the medium and short term into your trading and your models?
Okay, so for example, that's where we built what's called the medium to long term model, right? And that's two components. One is the long term, and that long term is basically just saying, is this a bull or a bear market? And the second component is the medium term. So is this one of those big 15, 20% corrections, or is it just, for example, a 6 to 10% correction, right? And so there's a big difference between predicting a 6% decline and, for example, a 15% decline, right? That's more than double. And what you end up seeing is that a lot of the 6 to 10% declines tend to be random, right? And it's not triggered by news. They say like, oh, it's because interest rates are rising. Well, interest rates have been rising for a while. And if you were to look at the actual statistical correlation between interest rates and the S&P, it's pretty much random, right?
Right.
So basically using those kind of statistics, what it tells you that some factors aren't as important as you think. But going back to the big correction, the 15%, 20% correction criteria, what you see is that all of them tend to happen for a big specific reason. And I'll give you a very simple example. They say that the 1987 crash was very hard to predict, right? But it actually wasn't. It was ridiculously easy to predict. Whenever the stock market goes up 80% in 2 years, it tends to get one of those big 20% declines. And that's exactly what happened before 1987. It's the concept of applying technical analysis, but to a very long term, using a long-term mean reversion concept, right? So that's one example. For example, 1987, it was a massive run-up, hence you get a mean reversion downwards, right? And for example, this year, we haven't had that. Yes, 2017, the stock market went up a lot, but it did not go up anywhere near the way it did, for example, from 1994 all the way to 1998, or from 1986 to 1987. There wasn't that much of a mean reversion requirement, right? So we use these long-term technical indicators to determine when the stock market is going to make, for example, a 15 or 20% decline. And that's what we define as the medium term, right? And then you can bring down two more steps, which is basically the medium to short term and the short term, right? So the medium to short term it's kind of like two criteria. One, it's in terms of time. So for example, where is the stock market going to go over the next 3 months, 6 months, 1 month, right? And the short term is like where the stock market's going to go over the next couple of weeks to 1 to 2 months, right? And what you realize for that stuff is there are a lot of patterns that you see when you do all these technical studies for the S&P, right? And a simple example I can give you is that when the stock market's volatility is very, very low, like when it's basically trending upwards in a very, very narrow and straight line, of course there's going to end up being, for example, a 6 to 10% correction along the way, right? That's just how things are. But at the same time, that is not how bull markets top. For example, if you were to look at the last rally before previous bull market tops, they were very, very choppy rallies, right? For example, you look at the October 2007 top. Before that, you had a correction in February 2007, and then another correction in July to August 2007, right? Because if you think about the logic behind that, in a bull market, there's this constant buy the dip mentality, right? That never ends. The mom and pops, they're always buying the dip, right? Because that's what they've been trained to do for 5, 10, 15, 20 years, right? So when the people and there are always people who sell too early. So those people who sell too early, they spot the problem first, right? For example, like the 2007 top, that was very, very easy to spot. The housing market had already completely collapsed from 2005 to 2007. You look at housing starts, for example, right? It got cut in half. Like it was ridiculous, right? But the stock market still went up, because the key point to remember is that yes, while the stock market and the economy move in the same direction in the long term, leading economic indicators are also leading stock market indicators. That's the very, very important point to understand, right? It's not that we have to predict where the economy is going to go in 1 year, 2 years, 3 years. Nobody can predict that, right? Instead, all you got to do is look at what the leading indicators are doing. And if those leading indicators are still going up, then it means that there isn't going to be a recession or a bear market in the next, for example, 1 year, right? But if those leading indicators are getting worse, then it means that we are in a topping sort of pattern, right? So for example, 2005, 2007, the housing market, which is a key leading indicator for the entire economy and the stock market, had been going down. It had been going down quite drastically, right? So smart people see this, they see, okay, there's a problem, hence they sell it, right? But because there's enough of that buy the dip mentality still left in the market, there are enough people constantly buying and buying and buying and pushing up to new highs, but you can see the volatility is definitely expanding, right? Correction after correction, lots of volatility, lots of chop. That's what happens when you get big sellers and big buyers pushing in at the exact same time, right? And you can see the exact same thing before, for example, the 2000 bull market top, right? Bull market tops in March 2000. 1999 was a year of insane volatility. Yes, the stock market trended higher throughout that year, but it was also a very, very choppy uptrend, right? And for example, you see that in 1972 as well. Stock market peaked in January 1973, and 1972 was a very choppy year. It was not one of those years where the market just went up in a straight line. And that's how we knew that the January 2018 top wasn't the top, because before that, the stock market just went up in a straight line for 1 year. That's not how bull markets end. Bull markets don't die on euphoria. They die when euphoria has waned a little, actually.
So if you look at the markets now then, you mentioned a couple of leading indicators that from last time, like the housing starts. What are the leading indicators saying about the most recent stock market actions?
Okay, so basically, if you gotta look at the economic data as a whole. You can't just look at one, right? You gotta look at it holistically. So what you're seeing right now is that yes, this is still an economic expansion, but you're probably in the final 10% of it. Like there's not exactly a whole lot of room left, right? And the way these economic expansions typically die and how that connects with the stock market is that the first thing that goes down is housing. Housing and big ticket purchases like auto sales, because they're big ticket, right? People tend to cut back on those the instant they run out of money to spend, right? The instant they start to get tapped out, right? So that's the first set of indicators to get worse, to deteriorate. And that's exactly what you've been seeing over the past few months. But when that happens, the economy is still good enough. For example, the labor market is still improving, consumer spending is still improving, right? And there's still enough of that buy the dip mentality to push these 6 to 10% corrections back to new highs, right? But that's when it gets choppier, because after housing starts to deteriorate, the next one to deteriorate is the labor market, right? The labor market, for example, initial claims and even the unemployment rate in the U.S. is a leading indicator for the U.S. stock market, right? So basically, once initial claims and the unemployment rate starts to deteriorate, that's when you're pretty much at the bull market's top. Now, there's no way you're going to time the top exactly. Nobody can do that consistently and accurately, but that's the closest you get to picking these long-term bull market tops, right? So first, housing deteriorates. You get a lot more chop in the market, which is exactly what you've been seeing this year. So basically this year, housing peaked in January 2018. And then since then, the stock market has been up and down, up and down, up and down, right? But the overall trend is still going upwards. So after housing deteriorates, soon you will start to see initial claims deteriorate, right? The labor market deteriorate. So that will probably happen in Q1, latest Q2 of next year, right? For example, you look at initial claims and the unemployment rate, they're very, very low, right? And even initial claims, it can't really go down much longer. It's kind of flatlining here at the bottom, right? So once that deteriorates, that's when you get the big uh-oh sign, and that's when you're very, very close to the top of a bull market where it's just not worth hanging on to your longs anymore.
Yeah. So what are you suggesting that then perhaps there's, maybe next year we might start to see the bull market ending?
Yes, exactly. I think next year, and so we built the medium to long-term model, and that model has various components to it, and it has various components, and the components have to be checked off one at a time. For example, in a bull market, X, Y, and Z needs to happen, right? So right now, basically all the components except one final component has yet to be checked off. So all the components except one final component has been checked off. And that final component will probably be checked off at this rate somewhere in Q2 of 2019, after which we will turn long-term bearish.
So you think that final component is the labor market?
Oh yes, it's labor market plus interest rates. There's a way that we calculate interest rates, which tells us at what point it's too high and the economy can't sustain it. And at the rate that it's going right now, that's probably going to turn bearish sometime in Q2 2019.
Yeah. Well, if you're looking at these fundamentals in these reports, often they get revised a month later or a couple of months later. So, I mean, it's a little bit of a moving target and a little bit of margin for error there as well. So how do you account for that?
That's very true. So any indicator, for example, housing, they all get revised, and the revisions tend to be quite large. So one of the things that you got to do is when you're looking at the economic data, always ignore the month-to-month fluctuations and focus on the trend, right? For example, this month, because honestly, for example, even the labor reports, right? A lot of that stuff tends to fluctuate for statistical error reasons, right? Even in the 1990s, during the best of the economic expansion, sometimes the labor report would come out and they would show a net loss of jobs for that month. And the next month, they'd just soar right back up, right? Because these guys, they're not actually going around asking every single person, hey, are you employed? Are you unemployed this month, right? All they're doing is taking a sample size. And because they're doing that, there's going to be some error in that, right? So that's why you got to pretty much tune out the month-to-month fluctuations and focus on the trend. For example, a very common thing that we do is take a 6-month or 9-month or 12-month moving average of the economic data itself, right? So in a way, that's kind of like applying technical analysis to the economic data, right? If you were to take an average of, for example, the unemployment rate, then any given month's fluctuation is going to have that big of an impact on the economic indicator, right? But if you get that sustained deterioration, then that's definitely going to show up. For example, if you're using a 6-month moving average of housing starts, right? And that moving average starts to decline, well, then that's probably a sign of deterioration, because in order for that decline, it can't just be 1 month of bad data. It has to be a couple of months of consecutive bad data.
Yep. So you've talked about the long and the medium terms, and they're very much driven by fundamentals. But what about do you use technicals on like price charts and things like that, or do you stay away from that?
So yes and no. So so let me clarify that. So for my own personal portfolio, I only focus on the medium term and the long term. But for a client's portfolio for relatives, I use a short-term trading model for that. So the reason being is that the short term, in most cases, it is not much better than a 50-50 bet, right? And it makes sense because, think of it this way: today, some big guy with like a $10-20 billion comes into the market and he sells, right? You thought the market was going to go up, but because he decides to sell today, the market goes down, right? That's randomness. There's nothing you can do to predict something like that, right? Tomorrow you short the market, you short Apple or whatever, and Warren Buffett buys Apple. Like, what are you going to do, right? Stuff like that. It just happens.
Yeah.
But these random things, they may impact the market in the short term, but they have very little impact on the market in the medium term and long term, right? As big as someone like Warren Buffett is, he's tiny compared to the overall size of the stock market, right? That's kind of like what they say in Remnants of a Stock Operator. Nobody on their own can muscle the market to where it's going to go, not even the Fed, right? Everyone is just one actor in this market, and no actor is bigger than all the other actors in the market, right? So basically what that's saying is that the short term it's mostly random, and you don't tend to get a lot of clear signals, right? The only clear signals, of course, that you do get is when you get to a short-term extreme. For example, when the stock market falls a lot, right? How do you know that the stock market is at a short-term bottom? How do you know that it's at a short-term extreme? Hence, it's going to mean revert, right? Or if the stock market has gone up a lot, how do you know this is a short-term extreme? And how do you know that the stock market is going to fall in the short term, right? And that's where these technical analysis comes into play. So basically what we do is a lot of traders, they look at a chart, they say, for example, RSI right now is very oversold, hence it must be bullish, right? And what you want to do as a trader, which goes into the topic of you want to reflect as a trader, is that you always want to ask, is that true? You don't want to believe in what everyone else believes in, because it may very well be wrong, right? You always want to do your own homework, and you always want to check the facts for yourself, right? So, for example, RSI is very low. Is this as low as it gets? Does the stock market, or does whatever market you're trading, tend to go up when RSI gets this low, right? And that's where we just throw in the statistics. It's very simple. Just put it into Excel, and it's like, if RSI right now is below this value, historically, does the stock market tend to go up 1 week later, 2 weeks later, 3 weeks later, 1 month later, 2 months, 3 months, 4 months, 5 months, right? And then the Excel will just print out the probability of the stock market going up or down in the short term or in the medium term. For example, the next 1 week, the next 1 month, 3 months, 6 months, right? And the thing about probability is that it doesn't always work. That's just how probability is, right? For example, if you create this market stat, right? And it says, over the next week, there is a 70% chance that it's going to go up, right? Well, the odds of that being wrong two times in a row is 9%, right? It's not that you can't be wrong 2 times in a row. It's just that it's a very unlikely scenario, right? And really, if you think about it, trading is all about probability. There is no certainty in the market, right? Nobody can tell you, I guarantee the market's going to go up tomorrow, right? That's like Bernie Madoff, right? So really, all you have is probability, right? And what we're doing through these technical studies is we're quantifying that probability. Instead of just looking at a chart and kind of guessing, I think the market's very overbought, or I think the market's oversold, hence it should bounce, hence it should fall, we're quantifying that relationship.
Yeah. I think, though, with some of those studies and statistics on market behavior and probabilities, you can, depending on which way you dice it or which way you look at the markets, they can really, studies can conflict with each other. So how do you deal with that?
That's very true. There's never going to be a case when you get every single study is bullish and every single study is bearish, right? The stock market is or any market for that case is never going to be that clear, right? That's why you got to look at the market from many, many angles, right? You can never just use one indicator and be like, this is my holy grail indicator. I'm just going to use this, nothing else, right? Because there is no holy grail in the markets. If there was, somebody would have found it already and been a trillionaire, right? So that's why. So the thing is, you kind of want to focus on one market, because the more you focus on one market, the more you understand it. It's price action, right? Because really, if you think about it, all these technical indicators and these quantitative studies, all they're doing is quantifying price action, right? And when you're looking at price action, whether it be through a technical indicator on a chart or through these quantitative studies that we do, you want to look at it from many, many perspectives, right? And just get a sense of, as a whole, are the studies bullish or bearish right now, right? You never want to be like, this one study, this one indicator says it's bullish, hence I'm going to buy, right? You're relying completely on this one thing. And if that one thing doesn't work, then you're completely screwed, right? So, for example, the way we do a technical study is, for example, you look at the US stock market right now, right? And then you apply onto different kinds of indicators. For example, trend following indicators, right? Like moving averages, EMAs, that sort of stuff, right? And then you apply onto a contrarian indicators, for example, RSI, Bollinger Bands, distance, the market's distance from its key moving average, right? And then you do these studies for the market right now. And then you say, okay, so I have, for example, 10 to 20 studies right now. And as a whole, on average, what are they telling me about the stock market? So basically, you can't focus too much on one study or one indicator. You got to look at it as a whole. These indicators as a whole, what are they telling me about the market right now?
Yeah, I just want to switch gears now before we finish up for today. You made a comment about reflection there, and it reminded me actually of a blog post I saw on your website about the importance of reflection in trading, which I think is incredibly important, and not just in trading, but in all aspects of life. How did you come about realizing the importance or the power of reflection in trading?
Well, that was always trained into me by my parents. Working with them, it gives me working with them over 10 years is kind of like working under someone else for 20 or 30 years, right? Because you're handheld and then you're really taught everything that there is to know, right? And that was drilled into me from the very start, is that you always want to ask yourself, how can I improve? How can I improve? How can I do better? What have I been doing wrong? Who can I learn from, right? Because if you're not thinking that, then you're going to end up being stagnant, right? And so the key to reflection, I think, is to always focus on two things. One, what am I doing right? And really hone in on that, right? But two, and the more important thing is, what am I doing wrong? And basically in the markets, it's very obvious if you're doing something wrong. It basically means you're not making money, right? If you're underperforming buy and hold, which is basically anything a monkey can do for 10 years in a row, then you gotta reflect, maybe I'm doing something wrong. Maybe I gotta learn from someone who's doing something right? So you reflect on that. So I'm doing something wrong, hence I should go out and find resources, see who's doing it right. And I mean, in the age of the internet, in the age of Google, finding information is so easy, right? So you just do a whole bunch of research and then you see, okay, these people seem to be doing it right? And then you reverse engineer what they're doing. You say, what are the similarities between these people? Why is it that these people tend to be doing it right and that these people tend to be doing it wrong, right? What is the commonality between the people who are doing it right? And what is the commonality between the people who are doing it wrong? And once you get that insight, you just really drill in on that and say, okay, this seems to be the reason why these guys are doing it right. Hence, let me study that more in depth.
Yeah, well said. It's so obvious when you think about it, but sometimes we can easily get caught up in our own things and we don't even think about, oh, crap, what I'm doing isn't working. What can I do to fix it? So, yeah, well said. Thank you for sharing that, Troy.
And you're absolutely right. So the thing to do, I think, is for example, 3 months or every half year or, every once a year, set aside some time, set aside a couple of days for yourself and just really get into that deep thinking mode, that reflection mode. Cut out all the distractions and really focus on how can I improve? What am I doing right? What am I doing wrong right now? Sometimes that silence and that deep thinking can be very helpful, even if it, hurts you a little bit in the short term because maybe you don't have as much time, right? But in the long term, it's definitely very beneficial.
Yeah, absolutely. So thanks for that, Troy. Now, I'd just like to start wrapping up, actually, with some quick closing questions. Okay, the first question, what's the biggest lesson you've learnt through trading?
Always think that the unexpected can happen. And I mean, for example, 1987, nobody thought that could happen, but it did happen, right? So you always got to have a backup plan in case the worst case scenario does happen.
Yeah. What do you think is the most important ingredient to becoming a successful trader?
Definitely having an open mind. Because if you go into something, and it's not just trading with anything, right? If you go into trading or a business with, here's how I'm going to do it, I'm just going to do this, I'm going to ignore other things that might or might not work, then you're not going to improve over time. You have to have an open mind.
Yeah. How about favorite trading books? Do you have any?
Definitely. I definitely like the Market Wizards books, especially the Hedge Fund Market Wizards book. I mean, the first one, just Market Wizards, it was very good, but it's a bit old. For example, it just had a lot of the trend following stuff that worked very well in the 1970s and 1980s, but has deteriorated a bit over time. But the new one is definitely very, very good.
Yeah, they're all classics, I think. Now, what's the best way for listeners to either get in touch with you or to learn more from you?
All right, so the best way is to go to my website, bullmarkets.co. So that's where I share all of my market outlook and my quantitative market studies.
Yeah, awesome. I'll have a link to that from my website as well. So people are driving and they can't write that down. They can go and look at that and go and check out the website. You get a lot of studies and stuff on there. It's a very interesting read. Okay, well, thanks a lot for your time today, Troy. Is there anything else that you'd like to mention before we finish up?
No, not really.
Awesome. All right. Well, thanks again for spending time with us. It was really great chatting to you. It was very interesting to hear about your thoughts on the markets and the fundamentals that are driving it. So thanks again, and I wish you all the best.
All right. Thanks for having me on, Andrew.
Cheers, mate. Bye.
All right. Thanks.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.